the Spending Affordability Committee for the Baltimore County Council. Is there a motion to approve the minutes from the December 17th meeting? Is there a second?
So moved.
Yep. Just 1 second.
Second.
Thanks. All in favor, signify by saying aye. Anything opposed? No. Ayes have it. Thank you all for joining us. We have Dr. Carter online, and there may be other additions while the meeting's going on. So moving on to the consultant, economic analysis and personal income, Mr. Anirban Basu.
Right, thank you, and Happy New Year, everyone, and thank you, Councilman. So, we just had this kind of conversation about where the economy is and what that means for personal income growth in Baltimore County, and not much has changed in the last month. We are closer to inauguration, but I hope that I said last time that the economy has significant momentum. That level of momentum has surprised me over the last couple of years, that I did not expect consumers to spend as they have. I did not expect employers to hire as they have. And in particular, I did not expect, and who could have, financial markets to perform the way they have, that the S&P was up 23% last year after being up 24% the year before. And so we have these massive and very positive wealth effects flowing through American society. Not everyone, of course, owns stock. The wealth gaps in the country are massive, but that wealthy group is helping to drive that economy in various ways, whether it's business formation or their spending on their households. And so overall, when I look at retail sales, when I look at hotel occupancy, when I look at various leading economic indicators, I see positive things. We just got earlier this week a report from the JOLTS, the Job Openings and Labor Turnover Survey, indicating that the number of job openings actually rose last month, the last month for which we have data, which is November of 2024, from 7.8 million the previous month to 8.1 million. We have 1.14 job openings in this country for every unemployed person. So we have 8.1 million job openings, 7.1 million unemployed people. Unemployment nationally is 4.2%. Unemployment in Maryland is 3.1%. Unemployment in this county is 3.3%. Labor market is tight, and that suggests ongoing and fairly significant wage growth during the year ahead, and that's half of personal income. Personal income growth will be a little bit softer because we will not have the significant adjustments to Social Security payments that we had in prior years, but nonetheless, personal income overall is expected to grow in the mid-4s for the next few fiscal years. And then, of course, the county benefits from the massive increases in property assessments, on the residential side at least. And so the county's revenue situation, from my perspective, actually looks quite good. People can point out that, well, the state is in bad shape, and one might presume less support from state government to support local government expenditures. I think that that's true. Last I checked, there was a $2.7 billion fiscal shortfall. This number changes all the time. One day it's 2.9 billion, next day it's 2.7. In any case, it's substantial. I'm quite sure that what you will see is the governor issue a budget that is heavy on budgetary cuts. We might actually see a budget coming from the governor's office that offers actually certain rate decreases, as it turns out, and just a modicum of tax increases. I mean, so I don't think we're going to see a lot of agency spending cuts at the state level. There's no question about that. How that factors into the local level is unclear, but we will see a lot of state government cuts. And then one of the issues, maybe the issue for Baltimore County and the entire Baltimore-Washington corridor, is the fact that Donald Trump will be inaugurated in 12 days. We have people like Vivek Ramaswamy and Elon Musk between rocket launches talking about cutting $2 trillion from the federal budget. It's not going to happen. They're not going to be able to find $2 trillion, but there could be some agency cuts. We have a meaningful federal bureaucracy in this county, of course, home to Social Security Administration and Center for Medicare and Medicaid Services. We also have a lot of people who live in this county who work for federal agencies located in, for instance, Montgomery County and the District of Columbia, so on and so forth. And so there could be some risk to the macroeconomic outlook coming from that, but who knows? It's hard to know, because I've been told by many acolytes and devotees of the incoming president, don't take him literally, take him seriously. You know, he wants to push things in a certain direction. He wants to shrink the federal government, but don't take what he said about tariffs or cutting $2 trillion from the federal budget, et cetera, literally. We'll see where things go. And so that's, I think, by and large, my report. I think 2025 calendar year will be fine. Fiscal year 2026 will be challenging, but fine, because this county is going to have some revenue growth, particularly again from that real property tax collection side. So that's the report.
Thank you. Questions? Ed?
What does your crystal ball say beyond in 27, 28, 29?
No, I mean, we were actually talking about this, Ed, before, we started talking, the capital improvement program and, a lot of unknowns out there, right? Because, if we're talking about a year ago, we would have said that the number one stressor for Baltimore County public finances is the blueprint for Maryland's future and the expected increases in local government contributions to education. But now we're getting the sense, aren't we, that some of this implementation is not going to proceed as rapidly as we might have thought previously. And this has a lot to do with the fact that the state government can't really fulfill its part of the bargain, given this 2.7 or whatever it is $billion shortfall for one fiscal year, by the way. By the way, that's $500 roughly for every man, woman, and child in this state. I mean, that's a lot of money. And actually the fiscal shortfalls are predicted to be even bigger in out years, but a lot of that again has to do with the blueprint and its implementation. And my sense is the pace of implementation is going to change massively, and you'll see that in the governor's budget. Many people are going to be upset with the governor's budget, but I don't know what choices he has given what he is facing for this upcoming fiscal year. So I think that ultimately state and local governments have to balance their budgets every year, as you know, Ed. And to the extent that we have to deal with financial life by cutting back on planned expenditures, we will. You're right, we have a lot of capital, a lot of debt service prospectively in front of us. But what can I tell you? I don't have a crystal ball. And all I try to do is say for the next couple of fiscal years, I think we're going to be okay. But beyond that, like you say, fiscal years 28, 29, so on and so forth, who knows? I mean, if I told you this nation was going to have an artificial intelligence, technological and productivity enhancement boom, our outlook would be different. But I can't know that. If I tell you that we're going to be at war with Denmark in 6 months, or that, we're going to have 30% tariffs on Canada and Mexico and 60% tariffs on China, I will say that we're going to be in a pretty bad place financially as a country and therefore locally, regionally, et cetera. So it's very tough to say. But what I see for the next couple of years is we're going to be okay. We're going to be okay because the tax handles are performing. Wages and salaries are going up. That's good for income tax collections. We have a lot of capital gains out there built in now that presumably will be collected. And again, the real property tax assessments or real property assessments are very positive for us from a fiscal sustainability perspective going forward. But your guess is as good as mine.
I just a little follow-up, and that is when you're looking out, and of course, the longer you go out, the greater the error is going to be in whatever prediction is made. But we are certainly seeing, there was an article this morning of what it cost on a new car. The average person is now financing almost $1,000 a month bill. That's a pretty healthy chunk of change. Now, even if you go to the used car market, assuming we're not buying used EVs for the moment, but there are enough headwinds in there, particularly when you look at what we've historically looked at. I would agree with you that everything I was taught in graduate school about interest rates and economies, it's all gone out the window. But the Fed's long side interest rate is still staying up high and is going potentially higher because inflation has not gotten its head under control. And I don't want to be the boogeyman. It has nothing to do with Democrat or Republican, but it has to do with the concerns of the degree of uncertainty that we face versus the decisions these gentlemen have to make now. And that is that things don't look too bad now. And he's absolutely right. This fiscal year, good. The real property, absolutely, there are some drivers, but there are some massive storm warnings that are out there, in my view, that when you get into and look through your capital improvement program and how fast you want to implement what you've authorized as terms of debt and what you actually issue in terms of debt, that debt service can turn around, and if those rates stay higher than Prague had estimated, is going to chew up this very narrow debt service coverage ratio that you have historically had at 9.5%. If you really take all the stuff in there, it's been a little lower to remove what's supportable, non-supportable, but it could easily break the 10% barrier, and you're going to be reaching into your into your reserve funds to help your budget. My view is just adding on to him, but the demography issue is by 97, 98, this county's economy has been pretty flat. But in the demography group that I find myself in, the over 70 crowd, it's still building. I mean, and its consumption of services, its consumption of many things that are different than the historical past gives me at least pause for heartburn that the labor force that may be available to support whatever the economy looks like is going to be, but in 2 or 3 years, a very stressed out capacity of this county to produce the workers that, given whatever the pure economics of business is at that point in time. Would you agree or disagree that you're?
I disagree. I agree, I should say, completely. I agree completely. So, let me give you an example. We've talked about housing policy many times before, and we're just stagnant as a county economy. It's stagnant. But people say, well, why are then home prices rising in Baltimore County? Why do we see 20% or more increases in assessed values over 3 years? It's because we build very little new housing, and because we've got some demographics at work here. The millennials, the largest population, the largest generation in terms of population, that group will turn 45 this year, the oldest of that group. Many are now in their 30s. So they're moving out of their homes. They're looking for homes to purchase. They no longer want to be renters, but they can't find homes to buy because the inventory of unsold homes in Maryland is 1.9 months. In this county, it's 1.5 months. It used to be the case that realtors would talk about equilibrium being 6 months of supply. Now we're at 1.5 months. And so what we have here is a lack of housing units and lack of development, pushing up against these demographic shifts in which millennials now are looking for a different type of housing. They're moving increasingly to the suburbs from the city. And so valuations are going up because of that scarcity factor. And demographically, we are getting older, we're getting sicker, we're moving more towards fixed incomes. And to the extent that we've had in-migration, a lot of that in-migration has been associated with lower income households relative to the historic average household income. So you put it all together, this economy is not in great shape. But home values are rising, wages are rising among those who are part of the labor force, unemployment is low, 3.something in this county, I mentioned earlier, 3.3%. In Baltimore City, by the way, the unemployment rate is just 3.8%. The labor market's tight everywhere throughout the region. So you put it all together, we're okay for this fiscal year. Even though the state's gonna have to cut back probably on support to local government, we're probably okay for next fiscal year because my guess is, I look at the financial markets, the stock market, by and large, lots of optimism in corporate America. Lots of optimism post-election. And so I think this is a year in which corporate profits are expected to grow. This is a year in which corporate investment picks up. All things being equal, that's pretty good, I think, for Baltimore County, though we don't necessarily receive as much investment as, let's say, in Nashville, Tennessee, or something like that. But you're right, demographically, it's a bit of a ticking time bomb. So if I were an advisor to these elected officials, what would I say? I would say be very careful in your borrowing, because interest rates are going to stay higher for longer, and you should plan on that. One of the things I've said to audience is not to get into Republican, Democrat, or Donald Trump or anything like that, but one of the things I've been saying to audiences the last few days is, if I was an advisor to the president, and I'm not the president-elect, I would say, Mr. Trump, don't do too much. Don't do too much, because all you need to do is wait for this inflation rate to come down, wait for interest rates to fall, give the Federal Reserve a reason to cut interest rates further, and you will unleash, even passively, a plethora of new investment in America. Right? Whether it's a building of apartment buildings or whatever it happens to be, a lot of people are waiting to move forward with various projects, various endeavors. They're waiting for lower financing costs. So just wait and then take credit for it. But if you're going to initiate 20% tariffs on the Chinese, which many financial advisors expect that's what the number is going to be, if you have tax cuts and those end up pushing more money back into the economy, and if you have mass deportations, which, I get it, I watch Fox News once in a while because my mom makes me, but, we have something like 8.5 million undocumented migrants working in this country in landscaping, construction, food services, so on and so forth.
Snow removal,
agriculture, you name it. And so that's inflationary. All these kinds of policy maneuvers. So this county, if it tries to borrow too much money, it's going to be borrowing at higher interest rates, and it's facing these more challenging demographic issues.
right?
And that's the issue.
Councilman Marks,
You said we're all right this
You wanna
fiscal year and
hit
next.
the mic.
Oh, sorry. Yeah, we're all right this fiscal year and next fiscal year. Say 26.
Said you're right this fiscal year and the next fiscal year, 26 and 27?
Yeah, that's right. I think that that's right because again, it depends on you to a certain extent in terms of what kind of budget is fashioned here in Towson. So we might end up not being okay because we have a spending problem, right? We spend too much money. But on the revenue side, I think things are pretty good for the next couple of fiscal years. That's what I'm suggesting to you.
So you mentioned about property tax assessments and they grew 20% statewide. And it was the zone 2 that got assessed recently, right? So that's the wealthiest part of the county, right? That's Towson North.
That's right. So when you get, even if it's a 4% increase in a property tax payment per annum, right? From already, elevated tax payments, that's in absolute terms a significant chunk of money. So that's why I say, things look pretty good to me, even though the macroeconomy doesn't. I think here would be Ed's point, if Ed was saying this, that eventually we're not going to be okay. Because eventually the weak macroeconomic circumstances and more challenging demographics of the county are going to catch up to us fiscally, along with those higher interest rates. That you put all that together, I think we're headed to a worse place in out fiscal years. But in the near term, I think there's a fair amount of transparency here. We'll be okay from a revenue perspective.
Right. And so inherently, and you know this because you've been advising us for this long, this committee is not inherently a policy committee, yet our decisions absolutely affect policy from the executive side and what the budget looks like. I do, while we have you here, at least want to ask from a policy perspective, seeing that we're in an expectation that we're good this year, we're good the next year, and these pressures on top of us that you've already explained, what are some tangible suggestions that other than watch our spending, which easy enough to say, anything tangible? I mean, any suggestions from your expertise that you'd make a recommendation of that we consider or even advocate for?
There's so many things, right? So we got to grow this tax base. So I think for several years now, we have underinvested in economic development in this county. We don't market ourselves very well at all, in fact. And so that's one of the places I would expect, or I would think that we could make some more investment. And by the way, we now have a very effective, compelling head of economic development in this county. And so if he is armed with sufficient marketing dollars and sort of can tell the story of this county and why it's such an advantage to be here, why people doing business here can make more money than maybe doing business elsewhere for a number of reasons, then I think, we'll see more business formation, more business expansion here. Second thing, we've got a lot of wealth leaving the county, right? I mean, I feel like I meet more Baltimore County people in Naples, Florida than I do in Cockeysville. I mean, we've just lost so many wealthy people, and that out-migration of wealth continues. I don't know what this council or this incoming county executive can do about that, but when people feel that Towson is unsafe or White Marsh is unsafe or Owings Mills is unsafe, that can push a lot of people away. And so that's another thing, of course, public safety and so on and so forth, and giving people a feeling that Baltimore County is a really safe place to raise a family, et cetera. And then the third thing, we need more housing in this county desperately. And I would say this, I would not mind if there was some effort to upscale some of our communities. In other words, attract young, professional, upwardly mobile families in much larger numbers. People with higher incomes and higher future incomes, higher levels of education attainment, that kind of thing. Not to be elitist, but that's a great way to form more of a tax base. And when those new households move in, they're a source of net fiscal surplus, right? Because they're paying a fair amount of income and property taxes and probably using a bit less in terms of service provision and various types of services. So those are three things I would suggest, that we need to really shake things up. We need to, to change the trajectory of this county. Otherwise, we're going to end up in a very bad place fiscally.
And also just to, I guess, add on to what I'm also hearing you say, I think we collectively need to do a better job from a strategic standpoint of marketing what we have available. And because we are a safe county and we are a place that people want to live, because as soon as housing becomes available, all of a sudden it's not available. Folks do want to move here. There are other larger implications of, what focuses should be on what types of housing. But at the end of the day, we are safe compared to our neighbors. We are a good place to live, and we do have economic opportunities for folks, but I think we do a mediocre job of making sure that other folks outside of here recognize what our strengths are and why we're attractive in a place we should keep people and not have them move to other places. I don't want to belabor that point. David, did you have a?
Yeah, I mean, the other thing is, I mentioned this yesterday, is fixing the permitting system. It takes too long to get a permit in this county. And, and that time is money for these businesses. I mean, tens of thousands of dollars extra while they wait for the permits to be issued. Every one of us hears about it.
Yeah, no, there's a big upside here. And I live in Baltimore County. I'm a consultant to this group, but I live here for a reason. I love this county. It's a great place. And of course, we're on the Eastern Seaboard. You will not find a more densely active commercial corridor in this world than the northeastern segment of the United States. And we're right in the middle of it. So I think our outlook could be very bright, but somehow we've managed to make ourselves stagnant economically. It's permitting, it's a lack of housing, it's all kinds of things. It's perception, lack of marketing, it's zoning. I mean, how is it that Columbus, Ohio attracts billions of dollars of investment from Intel, and Syracuse, New York, and Boise, Idaho, and Sherman, Texas, and all these kinds of places? We don't have anything like that going on, by and large. I would love to see that kind of transformative mega investment that creates a new ecosystem, a semiconductor manufacturing plant, a battery manufacturing plant, an EV manufacturing plant, whatever it happens to be, that large investment, and you got to put together the deal. And we've had in this county historically a lot of economic development professionals who've been really good at putting together real estate deals, large chunky projects. You just don't see that in this county anymore. And I'm talking to investors who are saying, I'm talking to one group that's being refinanced, a real estate investor that's, it places money in real estate investments for its investors, and Jeffries is recapitalizing them, giving them a couple of $1 billion to invest in various real estate. They're a Maryland-based company, but they're investing almost all of their capital in North Carolina and South. They used to invest a lot of money here, but they only have 30 acres left in the Baltimore metropolitan area, and they don't want more. It's just the opportunities are not here. So somehow we have to shake things up and be less stagnant. Otherwise, it's going to catch up to us fiscally. And maybe in 2 years, I'm a consultant to this committee still, and I'm saying we're not going to be okay for the next 2 fiscal years.
Right. Ms. Irwin, did you have something to add?
I just wanted to ask how as far as your forecasts go, what are you looking at for next week? You're due to give us a new report next week.
I don't think the personal income forecast will change very much. I've been working with Shoko, who's the principal forecaster at SAGE, and I don't expect to see massive changes, even at the categorical level. I mean, what has changed? Nothing really. The labor market is still strong. Wage growth is still pretty potent. Population growth is non-existent in this county, and so that's one of the factors here. We know what the Social Security inflation rate is and transfer payments generally. So I think you're still going to see numbers in the mid-4s. Okay.
Thank you.
Yeah.
Any further questions for Mr. Basu? Ed?
The other thing that I'm a long-term member of the county. I've taught in the county, I've worked in the county. I'm a very pro-Baltimore County person. I think, though, that this region overall has just fumbled the ball on really its economic development. It's more than marketing. It's got certain assets and nodes that it really has not really taken and really pushed in IT and in lots of other, when you talk about Indianapolis and whatnot, I mean, there's more intellectual capital in this area than there is out there. But we've strategically, I've always been surprised in Baltimore County. There's really not been a strategic place. Oh, there's been some plans and some other things, but it's been so focused on real estate, which has been a historical driver, but isn't any longer. Not just because the land's not available, the infrastructure is older. So I really do think that as you begin to answer and look out in 2 or 3 years, you got to get a handle on not only the marketing, but where are the key economic growth nodes or nodes of intellectual capital that are in this area, and how they can be put together to really jam up the next level of growth, not just the cycle up, but the step up into what is going to drive this economy. It ain't going to be real estate. It's real estate seen its day, period.
No, but you can use real estate as a magnet, right? If I zone something industrial, I have enough acreage, I have a partnership with the University of Maryland, Baltimore County, or whatever it happens to be. So I make a deal and say, look, Intel, Samsung, Texas Instruments, General Motors, Ford, whoever you happen to be, NVIDIA, that this is a place we have created where somebody's going to take advantage of what we've created.
Certainly UMBC and their Research Park has tried to do that. College Park has tried to do that. It's just still something that's missing in terms of either leadership, in terms of dollars and cents behind it, probably all of the above. But there's attractive core assets here, mainly in the brain area. We got an energy problem. I don't need to tell you guys with the energy problem. It's Senator West drops me a note every other day on that massive problem up in the northern part of the county. If that isn't addressed as part of the infrastructure base, we got a real serious problem of the capacity to turn around and try, particularly since the demand in so many of these intellectual areas requires such a tremendous input of electricity. And plus you've got the potential new government coming or the old government going out that has a great desire to cut out gas in terms of whatnot and go to all electric. If that moves that way, it's going to be a mess.
Sure.
Yeah, I mean, just final point to that.
Philosophizing, but I mean, that's just some of the things that you said. What do you need to suggested things you can focus on your term future and it's called getting your act together.
Sure.
Yeah, we played a tough division. I'm not talking about the Bengals and the Steelers. I mean, from an economic development perspective, I mean, Massachusetts has some of these same issues. It's very expensive to live there, very high tax rates, some of their tax rates at least. But when you're competing against Vermont and Rhode Island, it's different. Our competition is Virginia and North Carolina, for instance, or land and natural resource intensive Pennsylvania, or retail tax-free shopping tax-free shopping in Delaware. And so these firms are looking to expand. They look around and say, Maryland is my last choice in this region. Our tax rates, corporate tax rate of 8.25%. And so the investment goes elsewhere. And so it's a statewide issue, and Baltimore County, just, largest county and large jurisdiction of this region. If the state does not improve its economic development competitiveness, it's hard for us to improve our economic development competitiveness, and that's where we are.
As always, appreciate the analysis. Look forward to you coming by at our last meeting where we make our final recommendations and hearing from you again. Thank you.
I'll see you in a couple of weeks. Yeah.
Appreciate it.
Thank you.
Moving on to the committee staff's general fund fiscal update. Liz Irwin.
Yes. Since we met last time, we received audited financial statements for FY24. FY24 revenues totaled $2.69 billion, an increase of approximately $75 million, or 2.9% over FY23 collections. And FY23 collections, as I mentioned last week, were very strong. Originally, both our office and Budget and Finance were anticipating a decline in general fund revenues in FY24, but income tax collections remained strong, and there was growth in property taxes and investment income. And I also mentioned last week, these numbers basically shook out as we expected them to, with spending approximately $30 million below budgeted expenditures. And as a result of the revenues and the expenditures, the budget relied on approximately $7 million of fund balance, which was significantly less than it had anticipated. So as of June 30th, 2024, the fund balance totaled approximately $674 million, or 25% of revenues. And that includes the Revenue Stabilization Reserve account, which must be at 10% of budgeted revenues. I will note that in reading bond rating reports and so forth, it seems now that 10% of revenues policy that the county has, it seems that a number of jurisdictions are aiming for more in the 15% range. But for now, we're at 25%, so we're above that. Moving to FY 2025, the budget includes revenues of $2.57 billion, a decrease of approximately $116 million, or 4.3% from the FY 24 total. Office of Budget and Finance's revenue estimate was more conservative than ours at the time the budget was submitted, but we were also anticipating a revenue decrease for FY 25. However, as I mentioned last meeting, so far, FY 2025 revenue collections are better than expected, primarily due to favorable income tax distributions. As of October 2024, Budget and Finance was projecting revenues of approximately $2.64 billion. Office of Budget and Finance projected an FY 25 fund balance drawdown of $215 million, mostly for PAYGO, one-time excluded items. However, as of October, which is before the positive November income tax distribution that we got, OBF's drawdown projection is less than $150 million, and it's all for one-time items. So sustainability-wise, as I mentioned last meeting, that's good news. Our office is currently projecting FY25 revenues upwards of $2.7 billion, including property tax revenues of $1.22 billion, which is an increase of 4.2%, and income tax revenues of $1.16 billion, which is an increase of 2.8%. Recordation and title transfer taxes are expected to remain flat in our projection. And based upon, this is a high-level analysis of, we're just looking at the totals. As I mentioned, that things are in a sustainable place in that ongoing revenues are supporting ongoing expenses. I'm going to fly at a slightly lower level in just a minute to discuss some fiscal issues, but first I'm going to bring FY26 into the conversation, which I did not mention last meeting. For FY26, property tax revenues are poised to continue to show strong increases based on what we just discussed, the state's recent reassessment of the counties. I thought it was the Western region, so I need to get back to you on whether it was 2 or 1. I want to double check that.
Eastern last year,
So it would be Western. It would be group 1 then this year.
one this year.
Yes. So we'll just go back and debrief on that, but that was my understanding.
Central is the wealthiest part of the county.
Right. And so I think we're in 1 this year, but I'll double check that for you. Specifically, taxable assessments grew an estimated 5.1%. Income tax revenues are also expected to continue to grow in FY26, though at a slightly lower rate of 1.6% based on conservative assumptions regarding the pattern of the state's income tax distributions. There's always a lot of, it's difficult to predict kind of as far as the distributions from the state, but we're still, so we try to be conservative in our assumptions there. And I think Budget and Finance does as well. Recordation and title transfer taxes are anticipated to rise slightly in FY26, marking the first increase since FY22 as buyers become accustomed to higher prices and mortgage rates level off. We're still refining this projection. We'll have something a bit more solid at our next meeting, which we include then in the report. Preliminarily, we're forecasting growth of approximately $78 million or 2.9% to $2.82 billion for FY26. And just to note that the actual growth over the FY25 budget is more like, is over 200 million. It's over like 250 million. So because FY25 is coming in better than expected. Does anybody have any questions so far? I was going to fly a little lower level now because that was sort of the high level discussion that I had already talked about last time.
Any additional questions? We can continue.
I'll keep going. Okay. Hopefully not too far into the weeds here. I just want to mention a number of fiscal issues that our auditor's office FY25 budget analysis discussed. And these all really relate to spending affordability from the perspective of the trade-offs that could eventually be required to meet a future spending guideline. So in other words, while the FY25 budget met the spending guideline, there were some fiscal issues that have been raised by committee members, and which I'm going to list now, many of which relate to existing cost pressures. First and foremost, we have the funded status of the retirement system. It's at 59% funded status. In FY25, the retirement system contributions that our general fund makes grew by $17.4 million, driven by mainly salary increases in recent years that exceeded the actuarial assumptions. So that's what drives that big increase in our retirement system contribution. And I can go into more detail about that, but I'm just going to more rapidly go through here. OPEB, we've climbed up somewhat on our OPEB funding. We're almost about at the PAYGO level where we're funding the current cost for retirees. We're not really putting a down payment for the future yet, but we're on a plan to do so. But that requires ongoing increases in that OPEB funding. Within the Department of Public Works and Transportation, we have waste disposal costs. Our budget analysis got into that somewhat. I don't need to get into the details there, but we also mentioned that there was a reduction in the storm emergencies program in this year's budget, which now we're getting snow. So we could see some pinching there. And there's some loop, the Towson Loop, some of those costs were funded out of the ARPA fund for FY25. Not a huge amount, less than $1 million worth, but it's still funding that will come back to the general fund for next year. We also discussed elevated vacancy levels, which obviously, as you fill them, that puts more pressure salary-wise. And the BCPS budget relied on fund balance of almost $50 million to fund its operating expenses. And then finally, we get to debt service, which in terms of the cost of funding bonds, it's gone down in recent years because we haven't had as much actual debt, but there's a pressure there related to component unit capital lease costs, which have risen in recent years. And then there's also capital lease costs of general government where we have equipment needs and those prices have gone up. So there's a pressure there.
All right.
So that's my fiscal update.
Great. Questions for Ms. Irwin related to the fiscal update?
See, the governor said he's making.
Sorry.
See, the governor's mentioned he's cutting $2 billion today. Do we have any specifics on that?
I don't have the specifics yet, but I mean, I imagine a lot of it will be related to education.
Environmental programs, that's what headline is.
Our general fund exposure is not huge in terms of state reductions. However, to the extent that the reductions affect, for example, the school system, that is where we could be asked to put up more to cover costs. So it's more of a wait and see at this point. Well, hopefully we'll know some more for the next meeting. It's a risk. I mean, I guess the whole point is that, and that goes along with, I mentioned cost pressures, but on the other side of the fiscal side is this whole economic risks side that has been discussed back and forth between Dr. Basu and Mr. Crawford, that there are these risks related to the state budget as well as the federal government and whatever happens there. Sure. And so that all creates this situation where caution is advised.
So if you wouldn't mind, if you can go ahead and start, I'll start with you with the preliminary discussion on the fiscal year 26 spending and debt service guidelines, because both will play into it. We start that discussion, but if you'd go ahead and start.
Sure. So the spending guideline is a recommendation for the maximum level of general fund spending for ongoing purposes. The spending guideline typically is calculated by multiplying the previous year's estimated base spending by an average personal income growth factor, a multi-year average personal income growth factor. And last year, the committee utilized the blended average of county-level personal income forecasts by Sage Policy Group, a 5-year average, and Moody Analytics 3-year average for development of the 4.36% growth factor. And I mentioned most of this last meeting, but as a recap, Sage's most recent report from October, which he's indicating isn't going to change much when he reports back in a week. The preliminary 4-year average personal income growth rate factor for FY 26 is 4.93%. That would yield $129 million of growth. And the preliminary 5-year average is 3.98%. That would yield $104 million in growth. And as I mentioned at the last meeting, the Office of Budget and Finance was looking at the Moody's forecast. At the time that when I spoke with them, it was 5.21%. That would yield $136 million of growth. And, I've been running different numbers. I've been running a middle of the road scenario between the Sage's 4-year and 5-year. At 4.5%, that was $117 million. It gives you an idea. We're talking about, when we looked at revenue, I mentioned revenues and the growth over what we expect to receive in FY25 is in the $70 to $80 million range. However, if you're talking about the growth from the FY25 budgeted revenues to what we're expecting to receive in FY26 preliminarily, we're up over $200 million. So it gives you an idea that we should be okay from on a sustainability standpoint in terms of spending for this next fiscal year, setting aside all those other pressures that I had mentioned.
And we'll be discussing between now and the last meeting where we make our recommendations, what a blended average would look like between 4.9 and 3.98.
Right.
Right. Okay.
And I can send out some, I mean, at your request, I can send out a number of different scenarios by email as far as showing the different growth rates.
That'd be helpful.
Do you want me to go on to the debt guidelines?
Just one
Sorry. Go ahead.
quick comment, Mr. Chairman.
Sure.
And that is that just the caution. We've used 5 years, we've used 4 years, and it's a smoothing function. But particularly when you look at the last 4 years and you've had extraordinarily good growth in personal income, if you intuitively think that that is going to be slowing down, but not stopping, but slowing down a bit, you can get too comfortable with the 4 year, then in other words, it's going to be biased to the high side at some point in time, rather than being practical and looking at a shorter time frame or a slightly longer time frame. So that's my only caution to you, is that your numbers are being biased in part in 4 years because you've had 4 great years of growth, and if you are slowing down, just to be cautious.
No, absolutely. I appreciate the comment. And I think we have been lucky and fortunate to benefit from those. I think
Good staff. I mean,
it's all the staff. It's all.
and you guys ask good questions.
I think the other piece too, and I have not been here. I was in Annapolis during some challenging economic times. We didn't have as high of a deficit as they're facing now. How dynamic and how flexible we can be within a fiscal year once we've made our recommendations, because it is about uncertainty. We're shooting for the best. We're using averages to determine how accurate of a picture we're going to set our guidelines on. I think that you're right, coming from our advisors and also from the administrations. There is some caution related to headwinds. And I know that sitting on this committee for 2 years and listening to it before, there's always been caution about it. But how do we average that, and how do we work that into our decisions so that we're not giving the house away too early, and we're flexible enough to address a downturn or pressures that have not been expected when they come.
The caution that I've had a bit is really on the debt side, and that is that you got a very aggressive capital program,
Right.
in part designed by matching state funds. You've also got an effort to try and accelerate. You've got a lot of cash on hand in your capital program. You know, I think the question was raised by you all last time, and we were talking about it. What's happening on the contract, the legal getting the money out the door before you start selling more and more bonds along the way? This capital budget that's now before you are, that you've already passed it. But as you look forward, just because you're authorized doesn't mean that you have to sell everything.
Mm-hmm. Right.
And that's where the cautionary side of how fast you want to go, how much cash you need in your capital funds to really monitor that, and to monitor, Councilman Marks, as you said, how many contracts are we signing out there? What's happening? Are they coming in above or below expectation as a lead indicator? And I don't see you having the information to have one.
Zerna, if you'd like to go into the debt piece, and then we can. No, it's all good. No, it's forward thinking because we're about to go into
Sure.
debt requests.
Our debt guidelines, the committee's debt guidelines are based on 2 common debt affordability indicators. The policies for the county's 2 current debt guidelines are as follows. Debt service shall not exceed 9.5% of total general fund revenues, and total debt outstanding shall not exceed 2.5% of total assessed property value. It's important to note that in the county has a debt policy. The policy ties to what is in the debt affordability study that's put out by jointly by Budget and Finance and the debt advisor, the financial advisor, Public Resources Advisory Group. And in that report dated November, I guess it was dated October, November of last year, the plan is to raise the county's debt service to revenues ratio to 10.5% for FY26. That ratio includes component unit capital lease costs. And it also includes a commitment to no longer use a net interest cost amount that would be offset in part by bond premium funds. So there's that cost that previously was getting netted out is now all in our debt service interest costs. But there are as I mentioned previously, the committee's debt service guideline and total debt guideline has always excluded component unit capital lease costs. And those costs have grown in recent years with mainly school system lease devices, the computers, as well as bus leasing. It's financing of the purchase of buses. But it's those capital leases. And so while we don't have direct control over the Board of Education's signing of those agreements, the Office of Budget and Finance has always included that in the net tax supported debt and the debt service.
It's also in the report though, right? It's not just a unilateral decision that's it's included in the report, right?
It is included in the report.
Right.
Yes.
Got it. Okay. Just making,
So I'm just
not making it arbitrary.
pointing out that the committee's policies are not completely apples to apples with those ceilings that are in the report because of this difference in inclusion or exclusion of the component unit capital leases.
Gotcha. And in purposes of our discussion, there is the report from November
Yes.
is we are considering in the request of an increase of our debt guidelines to 10.5%.
Typically, we would want the Spending Affordability Committee guidelines to align to the county's debt policies. So it's a policy decision though of this committee as to what it wants to do. As of the end of FY25, Budget and Finance is projecting that the county will be right at 9.5% when including those component unit capital leases. So when you take those out, you're under the Spending Affordability Committee guideline.
Right.
But then going into next year, it becomes, with their assumptions for where we'll be in terms of debt and debt service, they're saying we're going to be up over 10% for FY26
With those.
with the component unit capital leases included.
Gotcha.
That's what the report says.
So we are, in front of us is a decision that we'll have to be making this year related to a guideline change of 10.5% or some change.
This question is on the table, I would say.
Yep, there you go. Thanks. And also, as always, we're looking at what our spending increase will be, where we will come up with a number. We're at least going to run scenarios. You're going to share them with the rest of the committee
Right.
between 4.93 and 3.98. Gotcha. Anything else to add before asking for folks from the membership to ask questions or no?
I would just note that March is the date when the planned debt issuances will be happening. And it's the costs related to supporting that debt, which is, $100 million in capital lease costs, financing, and then also new bonds that the council approved to issue. But the issuance itself, that decision happens in March as an executive decision.
Right.
And then once there's an issuance there, that will drive the debt service costs for fiscal year 26.
Great. Opening up to the members for discussion related to the 10.5% increase in our debt guideline, and that we don't have an exact number for a spending increase, but just what's in front of us right now with a 4-year average of 4.93 and a 5-year average of 3.98. Just open it up to the members for discussion or questions for Ms. Irwin.
Do you need the money? If you look at the capital funds that you have on hand of what your Office of Finance has and your spend down, I'm not saying that you don't need the projects, But do you need to sell as much as you're talking about at this time that potentially breaks your own guideline? The general funds that you have on hand, the reserve funds you have, they're in good shape. They're in good shape. There is a bias in the credit rating areas as credit is being used so effusively these days by so many people, governments included, that the balances do need to come up. And probably 14 to 15% is somewhere in the ballpark. You're are ahead of the game, but that can be chewed up very fast. Again, I think you need to look at it in the context of how fast are you spending the money. Just to go out and sell bonds, you can't arbitrage the bonds. That's the federal tax law. Either you sell 100 million and it's a 5% rate, or you're holding to the money, it's 5%. You just can't do it. So, but if you're sitting with just wads of cash in your capital fund account, why in the hell are you spending the bonds? Some people would say, well, it gives you the flexibility to adjust things around underneath the accounts. To some degree, yes, but only to the degree that you got the contracts and everything else to maneuver the funds around, or that it's going to not just spend. I mean, when I was in government or the federal government, part of the game was at the end of fiscal years, particularly in the Defense Department area, was just spend the damn money and get it out the door. I don't care if you get it out there. Well, that's not a very good long-term strategy of what you need. And that was where my caution in looking at your numbers would come into you all.
Right. Well, and I would say that I think, at least in my experience too, notwithstanding, I think that experience of spend the money because it's coming to the end. If we don't spend it now, we'll get less next year or something. Does exist. It's not, just anecdotal. It's in practice. And I would like to say that, from what I've experienced too, from the bigger picture, individual departments might be making those determinations for themselves, but I do feel that we've been in the bigger picture, and working with the administration and with this committee, stayed below that. And while we have commitments on the books and we have questions on our side about how the money's being spent or why do we see a large balance, but also not being in the room or also not part of the process determines when and how that money's being spent. There's always going to be that gap of information that we see. I'm not disagreeing. I guess I'm saying that I think from the bigger 30,000-foot view, we aren't spending it because we have it. We are keeping a good balance, even above what we're supposed to make sure, I would say, when something does happen, we're prepared for it. I guess, but to your larger point, I think we're in this committee too, making a determination for ourselves without being part of the administration. What are our needs versus our wants? And how can we balance both with the expectation of potential trouble in 2 years?
The histrionics of some of the debt issuance, to go back to the prior chief administrative officer and his view of the world. And he had a very strong role. And it was put the bonds out there and we've got a lot of money in there because we maneuvered around. Well, that's good for a certain point of time if you're growing very fast and you can really get it out the door. If we're growing slower, where we are now, again, my only is I think, as you all have seen, are the other indicators of capacity to spend and get it out and do the things you need to do, are they in line with the need for having all this cash on hand that you need arbitrage?
Sure.
That's it.
Questions for Ms. Irwin? Continue the conversation. Councilman Jones, I don't want to put you on the spot. Just if I wanted to give you an opportunity if you had any questions or just wanted to put it out to you.
I thank you very much. I don't really have any questions. I was just taking it in, and it's funny. I'm still laughing after what Bond said about his advice for Trump. And I'm looking at the news, and Trump talked about taking over Iceland and annexing Canada. If I was to tell him don't do anything, I'm saying to myself, man, that's so far-fetched. He would tell Trump not to do something. He has the power. He's going to do something, at least try. But as it relates to the debt, no, I don't. I mean, right now it's just, basically asking for, as I understand it, somebody can correct me if I'm wrong, asking for an event, like an increase in the credit limit of your credit card. But right now, I have not said that we're going to spend it anyway. So I don't have any.
Okay. Thank you, Councilman.
Mr. Irwin, Mr. Reed,
just kind of respond to the statement. The council has authorized capital projects and we're just not. Mr. Reed, Ms. Irwin, just if you could respond to this statement. I think, Ed, you alluded to this. The council has authorized capital spending and the money's not getting out the door.
Councilman, I think Mr. Crawford said it right last meeting. We're working on a cash flow basis, right? So we're only issuing debt as we need to in each cash fund. So when we're looking at our upcoming issuance in March, I think we're looking at $177 million for CPI. And a lot of that is in relation to the what we need to borrow for public schools. So although there might be some other cash in other buckets that we can't move around, right? We have to stay within the same buckets of major cash categories. That is the issuance plan. That's also under, again, what we had planned, from a cash flow standpoint when we talked about the bond ordinance. So again, we will not borrow if we do not need it. But these are what those figures, what we're using again from the debt study from October, November, are where we need to be to end up this fiscal year to have our cash funds whole in the capital budget. I think Mr. Crawford also mentioned, the spending to spend. We don't do that in Baltimore County. I mean, if, as Ms. Irwin just pointed out, we ended up FY23, or actually 24 with a $30 million fund balance. We control in the budget office quarterly spending from our general fund on the operating side, to try to balance out and to try to move our fund balance forward each year at a reasonable level. So we do have those controls on that. And again, we will not borrow if we don't need it. It's what we need to do to make the cash funds whole. But again, a couple things that why we need to really raise this limit, not using bond premium to pay for interest costs. I mean, that was a decision that this committee made a few years ago. We used to pay for that using bond premium. I have to put that on the books now, which again drives up our debt service costs. And as far as the leases, capital leases for our component units, that's debt that counts against us, right? So our financial advisors, in an effort of transparency and to have it all in one place, that we have to have that included, which we do in our debt study, that if the committee makes a different decision that they feel that shouldn't be accounted, that's something that we have to account for over here in our debt study to have everything in one place. So again, that does count, that's part of our package. So it's something that we feel necessary in an effort to have it all in one place and to have the full picture on our debt position to include capital leases for our component units.
Right. When was the last time that we increased the debt guideline?
It was about 10 years ago.
In 2014?
Yes.
Gotcha. And that's when we increased it to 9.5?
Yes. I forget if it was FY14 or FY15.
Okay. No worries. It's in the ballpark. Thank you.
And this takes us up to Anne Arundel County, right? Anne Arundel County will have this limit.
I guess
So Anne Arundel County is at 11.5.
Okay.
So we again had our financial advisors survey other AAA rated counties to make sure that we were in that ballpark. And again, this was their recommendation that in order to proceed with this capital program that we've moved, it's an aggressive capital program, but it's something that's needed, right? We have schools we need to build. We have some major maintenance issues that this is a safe level for us to be at.
Right. And I think what's been brought up, and I think also in conversation leading up to this meeting too, has been we have an aggressive capital program. That's one, we know that, and you know that too, and we're trying to meet those commitments and obligations we already made. We also recognize that there are these other pressures that are less sexy, less ribbon cutting, and less newsworthy things that must be addressed and should be addressed, that over time have sort of fallen behind from a standpoint of getting the same amount of attention. So I think that's where we're at too, where we're recognizing and we're hearing those pieces, where we're not in the same rooms, the same meetings related to the discussions and needs for the capital decisions being made and the timeline for which they're being completed. We're getting on the back end the result of things that have been put off over years and decades, and dealing with the constituent and county resident experience of those things related to infrastructure, related to vacancies, related to the services they expect to get from and receive from the county government. So we're butting heads to the wrong analogy. We are at a confluence of what we have to deal with at our legislative responsibility and what you all are dealing with at yours. But I have consistently, and even since last year too, since chairing this committee, have appreciated your willingness to discuss and talk. And I know between now and the final meeting, we're going to shore this up and also, I think, come to a better position on the decision we make and being more informed about it and how it affects you, and making it a little bit easier for us to explain why we at this point must increase to a certain level, and being able to articulate that not just on paper, but for ourselves too and our constituents. So does that make sense? Absolutely. Appreciate it. With that, are there any other comments or questions related to the discussion for the fiscal year 2026 spending and debt service guidelines?
I presume that you haven't talked with the rating agencies at all with adjusting your debt service?
No, they've been included, but also if the rating agencies related to the increase, Ed, that's what you're asking.
Have they had any view whatsoever?
Is there a view?
Usually when you start to break your caps like that, you've got the flexibility to do it. Question becomes at some point in time, do you raise taxes?
Right.
And that's a horrible thing to have to say, but the county's been extremely prudent on its rate.
It has, yeah.
It's basic relative to its growing box of needs. But, when you can start comparing all AA, all AAA, and look, my background is for 40 years, it's been in financial advisory.
Right.
Half the counties in the state of Maryland and West Virginia. And I've been sometimes as wrong as anybody else in looking at the future, but cross comparison, because the economic bases are so different to get to AA and AAA, and
Right.
what the dilution effect is to just, you have to take some of that with a grain of salt that, oh, well, there's 12 AAA counties. We're no worse than they are. They're actually a little worse than we are. Just be cautious, because as Audubon had clearly stated, that the economy here is not very much of a growth mode. And that's cause for concern that you have to factor in.
Right. And I guess Mr. Reed, I think part of the question was about the response from the rating agencies, or what an expectation is. Have we had a conversation, or has there been any input related to these requests on our AAA bond rating, or what we expect them to see? I know if we go over the limit, that isn't set because we don't do anything, we're in a bad place. If we come up to the line, it can be perceived as a bad place if we're not doing other things to compensate. Am I making sense here? I think the question is about what are these decisions from the rating agencies? What have they said, if they've said anything at all?
So this is recommended again by the financial advisors. We do share the control analysis, this report with them. I think they would like to see that the debt policies of the legislative side and the executive side are in concert.
Right.
And that, we are moving forward with this plan in where we are in time, and that would
Hello, Sam. Hi, this is Councilman Julian Jones.
Yep. Councilman Jones.
Nicole.
Thank you. Go ahead. Yep. Okay. Understood. Yeah, I understand the need to be on the same page and moving it in tandem with each other too. But I also think too, from our own conversations, just like with a credit report, they're not telling you everything, but to your point, it is something that should be protected, must be protected. I'd like to point out too, that it's imperative that we maintain it. I think that there have been comments made in public and also privately by some members that seem to not understand the importance of the AAA bond rating and what it has on our fiscal ability to even have a capital project like this. To lose it would be an implication of millions of dollars, taxpayer dollars, that would be wrapped up in debt service because of the interest rate that we get and we benefit from because of the AAA bond rating. So I think the idea of just want to clarify for some folks that don't understand how important it is to maintain it. While this decision does coming up to the line put us in a bad spot with the rating agencies, does not doing anything put us in a bad spot. If we're going to be moving to a 10.5% as recommended and requested, what else are we doing as a county strategically to make sure that if we're going to do that, we are also shoring up other pieces that are indicating to them that we're not just doing it because we have a AAA bond rating, we're always going to have it, that we're trying to do it because we're trying to protect it and also taking other steps to make sure that we're in a good fiscal spot this year and in future years. Does that make sense?
Spot on.
Right.
That's good reserves. And it goes to the issue of the large unfunded liability in the pension program. And forget PRIF. I mean, the extra, that's all investment earnings anyway, that there's no county money that's involved. There's county expectations of employees that like to have more of a COLA, but that's not going to come about. But within your means, you know, the things that you control, just to be mindful.
Right. Thank you. Seeing nothing else and no other indications for comment, motion to adjourn.
So moved.
All right, all in favor, signify by saying aye.
Aye.
Stand adjourned. Thank you very much. Thank you, everybody. Oh, excuse me, I apologize.
January 27th.
The next meeting of the Spending and Affordability Committee will be on January 27th, where we will be making our recommendations at 1 p.m. in the chamber. Thank you, everyone.